My name is Bob Litterman. I'm a founding partner of Kepos Capital, a New York City-based systematic investment firm which recently launched our first carbon transition strategy. I'm also a member of the Ceres Board of Directors, and I served as the chair of the Commodity Futures Trading Commission's Climate-Related Market Risk Subcommittee, which published the report Managing Climate Risk in the U.S. Financial System last September. I'm here to introduce our next session, Regulating Climate Risk in the Financial System. In recent years, we have seen financial regulators from around the world taking action to address the risks the climate crisis poses to global financial markets. Now is a critical time for U.S. financial regulators. During this session, we will hear from 3 leading U.S. regulators who recognize climate change as a systematic financial risk and are charting a path to address both climate change and the long-term stability of the U.S. financial system. We will hear from the Honorable Lael Brainard, U.S. Federal Reserve Board of Governors, the Honorable Rustin Benham, Acting Chair of the Commodity Futures Trading Commission, whom I got to know through my work with the CFTC and whose leadership I highly value, and the Honorable Allison Heron-Lee, Acting Chair of the Securities and Exchange Commission. The session moderator is Stephen Rothstein, who is the Managing Director of the Ceres Accelerator for Sustainable Capital Markets. It's now my pleasure to pass it over to Stephen.
Thank you, Bob. Thank you so much. We are humbled to have you and our special guests to be on our panel today. We appreciate that general introduction. We're going to start with brief remarks from Governor Lael Brainard. But before that, I want to ask each of us, just take a second for our thoughts and prayers for our fellow Americans, whether they be in Atlanta or Boulder or throughout our country, that are facing either discrimination or other challenges, including gun violence. Thank you so much for your thoughts. Governor Brainard is an American economist who served in the Federal Reserve Board since 2014. She had previously served as the United States Undersecretary of Treasury for International Affairs. She now serves as the administrative governor and chair of several committees, including financial stability, Federal Reserve Bank officials, consumer payments, and clearing and settlements. She's also been a consistent leader on climate, community reinvestment, and so much more. Governor Brainard will have some brief remarks and be available for a few questions. Governor, thank you for joining us.
Well, thank you very much for the invitation to be here, Stephen. Climate change is already imposing substantial economic costs, and it's projected to have a profound effect on the economy. The financial and economic impacts are going to depend on the severity of the physical effects as well as the nature and speed of the transition. For those reasons, it's increasingly clear that climate change could have important implications for the Federal Reserve in carrying out our responsibilities assigned by Congress. Given the implications of climate change for both individual financial institutions and the financial sector as a whole, our framework has to incorporate both microprudential and macroprudential considerations. So 2 months ago, we created a new Supervision Climate Committee, the SCC, to identify and assess financial risk from climate change and to develop a program to ensure the resilience of our supervised firms to those risks. This SCC's microprudential work constitutes one core pillar of our framework. Since climate change and the transition to a sustainable economy also pose risks to the stability of the broader financial system, a second core pillar of our framework addresses the macro financial risks. So to complement the work of the SCC, the Federal Reserve is establishing a new Financial Stability Climate Committee, the FSCC, to identify, assess, and address climate-related risks to financial stability. The goals of the FSCC are to promote the resilience of the financial system to climate-related financial risks, to ensure coordination with the FSOC member agencies, and to increase our international engagement and influence on this issue. Macroprudential and microprudential objectives are often aligned. That's certainly true in the area of disclosures. Disclosures are important not only to enable individual financial firms to measure and manage their exposure to climate-related risk, but also for financial stability more broadly by enabling the market to accurately price those risks. And given the importance of consistent, comparable, and reliable disclosures to financial stability and prudential objectives, mandatory disclosures are ultimately likely to be important. There are situations, however, where micro and macro prudential goals don't fully align. So, for example, the use of climate-related risk mitigants, such as insurance or financial derivatives, can shift risk away from a particular institution, but may not reduce or eliminate risk from the system as a whole. So that's why we need to be mindful of the cascade of impacts and their implications across the range of our responsibilities. Our macroprudential work program is focused on assessing not only potential climate shocks, but also whether climate change might make the financial system more vulnerable in ways that could amplify the shocks and cause broader knock-on effects that could harm households, businesses, and communities. In some respects, climate change is similar to other financial stability shocks emanating from outside the financial system, such as COVID, which are difficult to predict and can lead to an abrupt reassessment of a broad array of outcomes and prices. However, climate change shocks differ in a few important ways. Unlike episodic or transitory shocks, climate change is an ongoing cumulative process, which is expected to produce a series of shocks that over time can change the statistical time series properties of economic variables. This makes forecasting based on historical experience very difficult and less reliable. The physical properties of the Earth's atmosphere, shown by scientific climate records and climatological forecasts, include the risk of irreversible tipping points. And quantifying the risks and implications of potentially catastrophic tipping points for the economy and financial system are extremely difficult. Second, there's substantial uncertainty about the nature and timing of the policy, behavioral, and technological changes that will occur during the transition to a sustainable economy, and this could create challenges for financial stability. And third, climate change might be expected to increase financial system vulnerabilities. For instance, such vulnerabilities could arise if intermediaries engage in financial contracts or take on leverage to shift climate risk in ways that leave the overall system vulnerable to amplifying effects or shocks. In addition, even well-informed investors could underestimate the likelihood of large shocks relative to climate, resulting in systematic mispricing of risk. And finally, vulnerabilities could result if climate risks in aggregate are systematically correlated in ways that are missed by risk models and difficult or even impossible to mitigate fully. So I will just briefly touch on three examples where you could see those kinds of vulnerabilities. One clear area is property and casualty insurance. While reinsurance contracts and agreements among investors can shift risks across the global financial system, some level of risk is likely to remain, and a lack of transparency could cause climate-related risks to build up in hidden pockets, embedding vulnerabilities that could result in cascading losses in the event of large-scale adverse outcomes. Second, the value of real estate in many areas is expected to be directly affected by the increased risks of floods, wildfires, severe storms, and sea level rise. The direct effects of these changes on homeowners and businesses are likely to be geographically concentrated and can have severe impacts on the safety and usability of properties. But as climate risks grow over time, the mortgages on these properties may also become riskier, along with financial instruments involving these mortgages that may embed opaque, concentrated climate-related risks. And finally, climate-related physical risks are imposing growing financial burdens on local, state, and federal finances. Increasing physical damage to localities necessitate higher expenditures to repair damage and to build resilience. Pullbacks in insurance coverage, the need to relocate or bolster infrastructure, and the rising need for service provision in the wake of disasters all add up to continued burdens on state, local, and federal authorities. This could place strains on municipal financing markets, particularly in areas of geographically concentrated climate risks, and could result in cascade effects if a shock causes investors to pull back from similar exposures. So in order to deeply understand these vulnerabilities and support the work of the SCC and the FSCC, we're building the requisite institutional capacity and knowledge. In particular, we're investing in new research, data, and modeling tools such as scenario analysis. Climate scenario analysis identifies climate-related physical and transition risk factors facing financial firms. formulates appropriate stresses of those risk factors under different scenarios, and measures their effects on bank and non-bank financial intermediaries and the financial system broadly in order to capture the potential for complex interactions. This is exploratory analysis, so we would anticipate long time horizon, substantial uncertainty, the use of qualitative elements, and reliance on external data and models. So to sum up, although these are not easy problems, it will be critical to make progress, even if initially imperfect, in order to ensure the financial system is resilient to climate-related risks and well-positioned for the transition to a sustainable economy. So back to you, Steve.
Thank you, Governor. That's so much information, and I only have about 4 hours of questions for you. I know I can only get to do one or two very quickly, but thank you for that. So what do you see in all of those efforts as the next steps, and how does the new FSCC committee fit in? And is that an all internal committee of your staff or external?
Yeah. I think, what we've been trying to do, I think, is recognize that climate change does have or could have implications for the Federal Reserve in carrying out several of our statutory responsibilities. So we've been taking a number of actions over the past few months to enable us to be more effective in carrying those out. So last September, we released an advance notice of proposed rulemaking that included its discussion for the first time of the possible inclusion of community development investments in climate resilience for purposes of CRA credit. Last November, the Federal Reserve Bank of New York actually co-hosted a public conference on reducing climate risk for low-income communities. Last November, our supervision report laid out the potential prudential risks from climate change, and our financial stability report laid out the potential financial stability risks. Last December, we joined the Network for Greening the Financial System. And last January, we created the new Supervision Climate Committee, which is very focused on developing a program and tools to ensure the resilience of individual bank institutions. And then today's, the announcement that we're doing, creating a new Financial Stability Climate Committee, the FSCC, is really intended to address those risks to the broader financial system. It's going to be a system-wide committee, an internal committee, but across the Federal Reserve System, because we have a lot of really great capacity in our reserve banks as well as the board. And we want to make sure that committee works in coordination with the SCC and supports the work of the FSOC and its member agencies in the areas of financial stability, as well as our work at the International Financial Stability Board. So with all of those things, I think we're trying to put ourselves in a better position to support broader work with other regulatory agencies that have responsibility for several core parts of this, both here at home and internationally.
Great. Well, again, there's so much you're doing. Thank you. I'm particularly excited about the FSCC. But in the interest of time, again, we'd love to ask you more questions. We know you have to go, and we have two other remarkable speakers. So, Governor, thank you. We look forward to continuing the dialogue with you. I now want to, again, thank you, Governor. Just following up on what Bob said, to welcome Allison Hearn-Lee, the Acting Chair of the Securities and Exchange Commission, and Rostin Benham, the Acting Chair of the Commodity Future Trading Commissioner. Allison Lee was sworn in July 2019, and she was designated the Acting Chair by President Biden on January 21st, and she brings to the SEC over decades of experience as a securities law practitioner. Commissioner Benham was nominated as a commissioner of the Commodity Future Trading Commission in July 2017 and was unanimously confirmed, that's a remarkable statement, unanimously confirmed by the Senate in August 2017, and he was also named acting chair on January 21st. Both of these individuals are individually and collectively enormous leaders that bring so much experience. Commissioner Lee, let me start with you. Can you summarize the important steps you've already taken in the very short time you've been chair, including the 90-day comment period that you announced last week?
Sure. Thank you. Thank you, Steve. Good afternoon. And thanks also to Mindy, Jim, Vina, Isabel, and everyone at Ceres for the work you're doing and for having me today. It's an honor to be here listening to Governor Brainerd and on the panel with Chairman Benham. each of whom, as you note, have made significant contributions to our collective understanding and knowledge of how climate risk affects financial markets. This is a very positive time for those of us long engaged on the subject of climate risk and the financial system. I've joined Ceres before to discuss the potential for systemic risk that climate change presents. And at that time, last fall, I had the benefit of the report from the Market Risk Advisory Committee of the CFTC and the benefit of research by the Fed as well. So because of the important work of colleagues and others, we've made real strides in understanding why and how climate risk poses a potentially systemic risk to the financial system, one that's unique in breadth, scope, and complexity, and warrants the urgent attention of federal financial regulators. So we're now at a point in the US where we're seeing increasing recognition across a wide swath of market participants of the risks and opportunities around climate and other ESG factors. And we're at the beginning of the work of considering just how we're going to confront those risks and opportunities. So the SEC, to your question, has been actively engaged in these topics for the past couple of months, during which time I've worked closely with staff across the agency to consider broadly how climate and ESG intersect with our regulatory mission. Climate change is relatively unique because of the systemic nature of the risk that it poses, but I mention ESG here too because the broader array of environmental, social, and governance issues are key for investors who are focused on sustainability. So at the SEC, we're working to consider climate and ESG as we move forward, and we are moving forward. First, we're moving forward on disclosure. The most fundamental role that the SEC must play with respect to climate and ESG is working to ensure that material information gets into the public markets in a timely manner. We need to ensure that stock prices fully, accurately, and timely reflect the relevant information so that investors can accurately price risk and allocate capital. And also, I'll note that ensuring that the appropriate, smooth, and timely flow of this information can certainly help avoid an abrupt and disruptive climate-driven revaluation of assets in our financial markets. So on the disclosure front, we have 3 projects underway. First, we're stepping up engagement with issuers on their current disclosures being made under existing rules to offer them comments and feedback. Second, we're considering updates to climate disclosure guidance issued back in 2010, so over a decade ago. And then third, as you note, last week I published a request for public comment with specific questions related to the contours of a regulatory approach at the SEC to ensuring consistent, comparable, and reliable climate and ESG disclosures. And these comments could help inform a rule proposal should the Commission so decide. So I just want to take a moment to encourage everyone here listening to please carefully consider the questions posed in that request and weigh in. Now, in addition to disclosure, we've taken a number of other steps related to climate and ESG risks and opportunities. We've added climate and ESG to the list of priorities for our division of exams as it conducts inspections at investment advisors, broker-dealers, and other registrants. We've issued a bulletin to help educate investors about ESG funds and various types of ESG investing. We're enhancing accountability for climate and ESG disclosures at public companies, investment funds, and investment advisors through the creation of a climate and ESG enforcement task force. And that task force will carefully review existing climate and ESG disclosures for compliance with existing rules to ensure that the disclosures are complete, true, and accurate. And we're also looking at a number of additional areas where climate and ESG intersect with our mission. For example, accounting and auditing standards and credit rating agencies. We're also considering ways to increase accountability and transparency around the proxy voting process because, as you know, most, if not all, shareholder proposals relate to either the E, the S, or the G in ESG. And importantly, we're working closely with our regulatory counterparts domestically and internationally through bilateral talks and through the important multilateral work being done through the FSB and IOSCO. So all of that is to say that these issues intersect widely with our mission at the SEC, and we're working hard to ensure that we address them in a prudent and efficient manner so that investors have the information they need to price risk and allocate capital as they deem appropriate. So there's a lot of work ahead, and I'm looking forward to engaging with my fellow commissioners and market participants to get it done. We'll stop there, so thank you, Stephen.
That is so much in 2 months. It's quite a list. And again, like Governor Brainerd, I could only ask you questions probably for the next 3 hours. But let me just take one or two before I get to Commissioner Benham. But I do want to publicly also thank your staff and Commissioner Benham's staff for all that you've been doing and all that you do. It makes such a transformative impact. You both are so lucky to have such quality folks there. Talk about the 90-day period. You have 15 detailed questions, and it's probably, the way I counted, probably 40 or 50 questions embedded in them. Tell us your thinking behind those, and what are you hoping, and give a sense of the timeline to analyze what I, like you, hope there'll be lots of rich comments.
Sure. I got to start, though, by echoing your compliments to the SEC staff, because they are really the ones who have done all the work here, and it's been just tremendous effort on their part. So the questions, my hope, as I said in my opening remarks, is that it will help inform a rule proposal if the commission should decide to issue a rule proposal going forward. Of course, if they do that, there'll be an additional period of notice and comment that would come after that. But these issues are really complex, and there are a lot of varying views. So I think it would be helpful to get input even in advance of a rule proposal. And you probably know we've received thousands of comment letters and rulemaking petitions on the issue, but the comments have really been more in the nature of a request for us to act, rather than the more granular comments regarding how we might stand up a disclosure regime. So that's the thinking. You kind of busted us by pointing out that it's purports to be 15 questions, but then there are a lot of sub questions in there. But that's really designed to try to get at, as best we can, the details around how to stand up a potential disclosure regime and help us come out with the best possible rule proposal should the commission decide to do that.
That's great. Well, again, I like you, hope everyone submits comments, and if anyone wants, let us know. Ceres will be submitting comments, and look forward to working with you. Now let me welcome Commissioner Benham. Really, your leadership in establishing and guiding the Climate Risk Subcommittee in 2019 that then led to the landmark report last September has really changed the conversation, has literally changed the conversation. Can you share a summary of the report recommendations and your plans on climate risk, including the new climate committee you just announced last week at the CFTC?
Thanks, Steve. Appreciate that introduction, and I want to thank you and Mindy and everyone at Ceres for hosting this great event and for inviting me back to participate in this discussion. And of course, I want to commend and thank Acting Chair Lee and Governor Brainerd for their leadership and spearheading efforts at their respective agencies to increase, any number of things, including disclosure, as Acting Chair Lee just talked about, or macro and micro prudential stability, as Governor Brainerd spoke about. This is really a collective effort, and it's really great to see all of these initiatives happening across the government. And quite frankly, Steve, you said it, after the report was published in September, I was, had the opportunity to speak with Vina and Mindy and Bob Litterman, who was the chair of the committee. And we discussed the report itself. I think it was just a few days after the report was published, and it's pretty remarkable how much has changed in just 6 months. A very different posture and different position back then than we are here today. And, there's now, without a doubt, a common understanding at all levels of the US government. And certainly, I think, a growing understanding, as you pointed out, across the private sector, that climate change not only presents systemic risk, subsystemic risk, and subsystemic shocks, and then a various number of wide-ranging ripple effects to the US financial system and the larger economy. But with that, and I think this has been pointed out by both of my predecessors and colleagues, that there are, in fact, many opportunities as we work to ensure decisive and cohesive leadership over the markets and the institutions that are charged with monitoring and managing risk, capital, and asset allocation, especially as the physical risks of the sudden and extreme weather events that we continue to experience, which are associated with climate change, have an increasingly profound impact on our most vulnerable communities. We're all here today, and I think many of the panels that we've heard from and will hear from later on are here today as leaders engaged in bringing climate change more conclusively into the regulatory fold to ensure that the structures and the tools and the strategies, the products, the individuals and the staff and the policies that are in place to address physical and transition risks that we as a global community are facing. We start building better equipped financial systems now that both acknowledge and account for the inevitable impacts of climate change. I'm a firm believer that we can be positioned to avoid the need for extreme shifts in balance sheet management and fiscal and monetary policy in the future. Steve, as you pointed out, in November of 2019, I formed 34-member climate-related financial market risk subcommittee within the MRAC, which was chaired by Bob Litterman. And the climate subcommittee had a very broad mandate. And as I pointed out earlier, it was a different time then. It was only 2 years ago, but a very different posture and different time. And I thought it was important to have a broad mandate given the individuals I was able to convene. They provided an analysis and recommendations regarding the existing and the emerging risks and impacts of climate change on financial markets. And in my view, the climate report exceeded all expectations in tackling the challenges of how to safeguard the financial system in the face of really uniquely complex risks presented by climate change and how to facilitate the transition to a low carbon climate resilient economy. I think recognizing these unique circumstances in the US, which include a multifaceted system of financial regulation and multiple regulators, the climate report had 53 recommendations and provides, in many respects, a resource to interested policymakers, regulators, and stakeholders as our nation really begins collectively to move and begin the process of taking thoughtful and intentional steps towards building a climate resilient financial system. And that prepares us for the decades to come. As detailed in the report, we can start where many of our international regulatory and supervisory counterparts and domestic private sector entities have already begun, by rethinking our political and corporate culture so that our economic pillars are less vulnerable to climate shocks. Recent discussions have highlighted that if and when the US presents its approach in terms of standards, taxonomies, disclosures, accounting, and capital in managing both the risks and the opportunities of climate change, we need to ensure that adoption and compliance can be achieved across jurisdictions. We can't harmonize just for the sake of harmonization. We need to partner with one another and with industry to ensure that there is appropriate flexibility and a focus on returns for our efforts. So with all that said, and Steve, you mentioned this, as I've taken over the role as acting chair and as my fellow colleagues have taken on amazing initiatives at their respective agencies, I announced the establishment of the Climate Risk Unit, or the CRU, within the CFTC last week to focus specifically on the role of the derivatives markets and the CFTC as a market regulator in understanding, pricing, and addressing climate-related risk. To the extent that the new products that are listed on a futures exchange and market developments must accurately, uniformly, transparently, and fairly factor climate-related risk into pricing and related market functions, the Commission, the CFTC, needs to engage early in order to ensure coordination within the larger financial regulatory space, both domestically and abroad, and to provide support where we can. The CFTC's unique mission, which is focused on risk mitigation and price discovery, in my mind, puts us on the front lines as we will increasingly need to use our wide-ranging and flexible authorities to prepare for and address the impact of increasingly severe and frequent weather events, as well as the transition to a low-carbon economy. As I thought about the future of the CRU and the CFTC as a resource for policymakers across the globe, the goal is really to dedicate the resources we have towards raising risk management awareness and visibility within our markets and the broader economy so that we can identify where the holes are, where we need to be most vigilant in both our support and leadership as regulators. I've heard time and time again and agree that the approach we take in integrating the physical and transitional risks of climate change into our financial markets will be most persuasive, create the most incentives, and provide the largest returns when we use a common language and taxonomies, develop relevant and reliable data resources, and focus on building resilient through flexible approaches as opposed to a one-size-fits-all solution. So early days for us at the CRU, but we're starting to put together an internal team and certainly working with my colleagues across the US government and overseas, but a lot to learn from the report, which was a private sector-led initiative with a diverse coalition of members, but a lot to look forward to, I think, both from a risk management perspective so that we can transition smoother to a low-carbon economy, but also the opportunities that the transition presents for our economy writ large. I'll stop there, Steve. Thanks.
That's great. Our problem today, we have an embarrassment of riches of all the three great speakers and all the things you're doing. How much do you hope the CRU looks at the report for the specific recommendations of the CFTC as compared to the other market participants and tries to walk through each one and see which ones and to make sense and which ones to implement? Or do you think the agenda will be somewhat different?
Well, I mean, in many respects, this is, for me personally, a pivot to a different initiative, a pivot to a different, really, goal in terms of moving away from the report, understanding that hopefully it will set a standard and at least be a benchmark or some, in many respects, an informational tool. But the CRU, like I said, is going to be focused strictly on derivatives markets. There are a number of recommendations within the report that focus on derivatives markets, but there are lessons learned, I think, from I mentioned the diverse coalition and finding consensus that I experienced, which was both a challenge and rewarding in many respects, to get this group together, work with other regulators and see what we can do from a data perspective, see what we can do from a markets and products perspective. The CFTC and derivatives markets are going to play multiple roles. From a risk management perspective, we need new innovative products to deal with physical risks. From a financing perspective, as we transition to a low carbon economy, there's going to be a large demand for financing new infrastructure and really new foundational economic pillars. And whether it's traditional derivatives in the interest rate space, the currency space, or the credit space, these are the types of products we're going to need. And then writ large, as we transition our economy, we're going to have a lot of bumps along the way. We all know that. That's going to be the biggest challenge I think we face as a global economy, is moving away from core energy sources to new alternative sources. And again, derivatives markets play a role there as well. So in many respects, things we do already, but other respects, things that I think the agency needs to engage on with stakeholders so that we can create incentives in the appropriate places, but work with stakeholders so that our new products and new innovation can really be supported, so that the transition becomes a smoother process as we look towards 2030, 2040, and 2050.
Great. So let me go back. Question for both of you, but start with Acting Chair Lee. Some have claimed that a lack of data and modeling certainty should delay action. Others say, no, we have to act now. The problems are today. What's your perspective, and what expectations to address risks do regulators have now about this data question?
Sure. I mean, that's clearly one of the massive challenges that we face. And first of all, you heard Governor Brandt refer to some sort of open source modeling that they're going to help with, and many others are doing that too. So I think it's going to have to be, or I should say, I know it's going to have to be an iterative process. We're going to have to give companies room and flexibility to sort of experiment with, learn from one another, learn from what kind of open source modeling we have out there, and have safety and flexibility around that so that we can get it right. It's not as simple, and this has been repeated many times, it's not as though we can just take historical risk models that, transport them from other areas and use them here. So completely take the point that it's difficult. Difficulty cannot be the reason why we slow down or stop. We have to move ahead. The problem is pressing and urgent. We know this, and we know that, so we have to move, but we have to give companies flexibility to kind of engage in an iterative process, and we can all kind of work together to get to the best results.
Great. Commissioner Benham, do you want to add anything to that, or I can go on to the next question if you
No, I agree with everything that Acting Chair Lee said. I would just say, and this is a little bit corny, but we can't let the perfect be the enemy of the good here. And we have to just, this goes to the heart of transition risk, that, if we all believe here that climate change poses an existential crisis to the globe in the years ahead, we have to act now, and we have to take risks now in order to eliminate, or at a minimum, reduce the risks that we're going to face in the future. And in many respects, you can view it sort of as a zero sum, because we're still going to have risks down the road. We're not going to, this notion of getting to either net zero or net negative by 2050 is ambitious, and it's going to be hard. We're going to need carbon markets. We're going to need carbon offset markets. But these are targets that are going to be very, very difficult to hit. and we understand the repercussions that we're going to face in the decades to come. So I think we have to think very creatively and ambitiously now to think outside the box so that we can potentially take on risks now as we transition. And that means, look, not everything's going to be perfect, whether it's the data set, the taxonomy, the disclosure regime, the stress testing models and the methodologies behind them. But we have to start moving the conversation forward. We've been having this discussion about climate change for decades now, and you're really starting to see this snowball effect across the economy, even in the past several years, let alone the past 5 or 10 years. And it's time to act, and we really have to act collectively and use whatever tools we have and the best tools we have now to start the process. And as Acting Chair Lee said, iterative, flexible, working together, and just adjust along the way. And that both comes from a regulator standpoint and a private market participant standpoint.
We only have a few minutes left, so I'll ask you to keep the answers brief if possible. But we're seeing private sector activity every day. Just earlier today, the CEO of BP was on the panel. Tonight, Bill Ford from Ford Motor Company speaking. The 6 largest banks have all made commitments. What role does the private sector commitments make on your decisions? Commissioner Lee, I'll start with you. And
Sure. Let me try to keep it brief. I will start with those are significant and important commitments. So I welcome those. I think most of us do. I think we need to ensure that if this is what they are telling investors in the markets, that they're disclosing the material information about how they're getting there and what they're doing to hit those targets. How will that affect their financial performance? And over time, are they meeting those targets? And if not, how will they compensate? So it does raise a host of questions that are important that I hope we'll see the answers to. Secondly, I also think it's really important that they're using the TCFD and other regimes. We need to learn from that experience in disclosing under the standards what works and what doesn't, and then build from there.
Sure, Benham, do you want to add?
Yeah, the only thing I would add is, on substance, I agree everything with Acting Chair Lee said, but in principle, what you're seeing is the largest leading companies, global companies in the world across the sort of industry spectrum start to take action and movements towards commitments of disclosures or net zero commitments. And I think what's important about that from sort of a global perspective is that that wave is going to create space for smaller companies, mid-sized companies, small companies to understand the direction that we are collectively moving. And I think that's why it's so critical to have the BPs of the world, the Fords of the world, and their leadership make these commitments, because I think it's really going to further that momentum that we're all talking about, thinking about, and hoping for to sort of achieve these goals globally. Because, we can't, whether it's country by country or company by company or industry by industry, we really need all hands on deck here, and we have to move forward together. And having these leaders and these companies make these decisions is just critical to get everyone else understanding what risks we face, what challenges there are, and then how we need to get there in a short period of time, relatively.
Great. I'm going to, one more question, again, ask you to keep it brief. I apologize, we don't have more time. Start with you, Acting Chair Benham. How are you thinking about water use disclosures, whether it be for agriculture or others, in terms of climate disclosure? And then obviously for Acting Chair Lee, as you think about disclosure, where does water use fit into that?
So from a CFTC perspective, it's an interesting question, Steve, because there's a water futures contract that was just listed in the past 6 months. And I think it was a real signal, to the market and us as a regulator, certainly myself, that, this goes to what I was saying earlier about the innovation on the product side, is that these scarce natural resources that we tend not to think about as scarce are becoming more scarce. And as we look towards the future where we have a growing population, less arable land, or at least the same amount of arable land, and potentially reduced natural resources like water, we're going to have to come up with risk management tools in a financial markets perspective to help with price discovery and sort of availability. So when we set up contracts within the CFTC, we certainly work with stakeholders, work with exchanges to ensure that the contracts display and show all the information we need to know and that's available. And I'm going to start rethinking about how we do that from both a carbon sort of footprint perspective, but also an availability and delivery perspective, including water. But it's a good example for us because water is becoming a scarce resource, and we're seeing these types of products emerge and grow with a full understanding that these are going to be the challenges we face in the future.
Commissioner Lee, literally in 20 seconds, how would you answer water?
I would just say that when we look at a regime, hopefully we know that there are going to be certain impacts that we're going to decide are measurable and important. This may be among them. That might be tailored for a sector by sector or industry by industry approach, but that's all part of the comment period, and I hope we'll hear from folks on that in the future.
Great. Well, thank you both for joining. We really appreciate it. Again, we could spend hours. As we put the final slide up, I want to just let people know we'll be issuing again another report called Turning Up the Heat, the need for urgent action by U.S. financial regulators in addressing climate risk. Thanks again, and have a great day, everybody.